Welcome to the free life insurance training brought to you by lifeinsurancetrainers.com. We're going to talk to you about the basics of a whole life insurance plan. Let's break it down to the very simplest I can make it, benefiting examples. Well, whole life typically has a fixed cost of insurance, a fixed cost. And that cost of insurance, for an example, is the year that you buy it as the obtained age. A universal life contract can go up each year, whereas a whole life locks in the cost of coverage at that attained age. Now, at some point, as you're paying your premiums, you can elect to stop paying premiums through what we call an offset or paid up premiums. So you can structure, now you're going to pay more money into that whole life contract, but the idea is that you would relieve the cost at retirement. The thing about a whole life that you need to remember, unlike any other permanent plan just about, and there are some exceptions, but most of them out there, whole life has guaranteed values. One thing that you can do with a whole life, when you place a whole life in a household, you never have to say, I'm sorry, because there's no chart, there's no part of that illustration that says this thing will crash and burn. All you have to do is make those premium payments, and this thing will do as good or better than what that chart says. And it's a contract. Whole life is a participating policy with the insurance company that you're placing the plan with. So as a consumer, if I'm buying a whole life, I'm actually participating in the dividend. That's how the policy grows. I'm participating in the growth or the earnings of that particular company. It's a contract. It's guaranteed to do as good or better than what the illustration says. So let's look at that as a visual. Okay, so you have this death benefit, right? And you have these level premiums. That's the neat thing about a whole life, is that it's going to have these level premiums. You can't, maybe the negative to it is you can't increase or skip those premiums. So it's a level premium. Now, you're going to have some cash growing into this whole life plan. And it's going to build every year that you put your payments in there. And some point, when your cash grows, it's going to force your death benefit up. You cannot have more cash into a life policy than what it's worth. So it's going to force your death benefit up. The cash value forces the death benefit up. So if you had $100,000 of death benefit and you're putting in cash, when your cash gets close or around that $100,000 range, it's going to force the death benefit up. And again, whole life plans have guarantees. So when you print an illustration to a whole life, it's going to do what it says it's going to do in that contract, no ifs, ands, and buts. Thank you.